starting up here soon. So he's in all the time. He definitely to work. Congratulations. Did I? Oh, no, they gave you two. There we go. All right, good. All right, next up is our healthcare team. We have a lot of really strong research for the healthcare team. I mean, all the teams do a lot, but this research team, I've been very impressed with how serious they're taking it. So we have Alan did Amgen, Brennan did Medtronic, Riley did, and Andrew did HCA. So the winner is Riley Irvin. And there's two things about Riley I think that are interesting. One is she volunteered to go at the equity workshop here recently, and she's also was chosen to be on our CFA team this year. So we expect to see more from her. All right, now we have the power team. The power team does 4 different sectors. They've got materials, they have energy, they have industrials, and they have utilities. It's a pretty big team, and they have a lot of great research coming out of there too. So Smithy did Boeing, Ben did Ormet, Jackson did Exxon, which you guys saw at the last ISM, and then Ben did Covenant Logistics. And so this one is really tough as well. And the winner is Ben. Come on down. For those of you who know, Covenant is also up, I think, nearly 30% this year. And it's also headquartered right here in Chattanooga. So I'll get on this side. There you go. Congratulations. And our last, okay, this is going to be the financials team. A lot of these companies are pretty tough to do. So a lot of this research required a lot of time and energy. I'd like to thank all the finalists. Ashton did Robinhood, Bo did S&P Global, Kyla did Klarna, and Chris did BlackRock. And the winner is, all right, Bo, come on down. All right. Yep. Vonnie did that to you, Bo. She said y'all are friends, so she's just messing with your picture there. Bo is extremely smart. He actually made the highest grade on my first test in investments too. He's always doing the right thing, and he's always, doing superb work. So I think it's great that he actually gets to for that. Congratulations. All right, so that wraps up our court ceremony and our awards. I know you guys came to see the students, so at this point, I'm going to turn this ship over to our captain. Take it away, kid.
Good afternoon. All right. Good afternoon, everyone. My name is Caden Christensen. I am the president and chief investment strategist. We're going to come back here. All right, here's the sweet spot. And today we're going to go over our second ISM for the performance update. To start, the traditional fund sits at $2.1 million, representing 54.8% of total assets under management. The strategic fund has grown from $700,000 to $775,000 since our last ISM, representing 20% of total assets under management. The style funds have begun to diverge their style for total assets under management, with the growth representing 9.1, core 8.2, and the value at 7.9. All in all, the fund totally has 3.8 million, which ideally we can hit 4 million by the end of the year. We'll see how that goes. We're always going to be ambitious here. Moving on, we're going to break out the traditional fund performance on a year-to-date basis. Currently, the fund sits at 16.4% compared to the benchmark's 17.5%, representing moderate underperformance of 1.1%. Since inception, the fund has underperformed by 26.1% or 0.8%. I would like to point out, however, that since our previous ISM, our annualized return has slightly improved from 0.9% to 0.8%. Now let's break out our style funds. Currently, the growth fund continues its tear with 12.9% of relative outperformance. Since inception, it is now positive at 2.7% and annualized at 2.3%. This growth primarily comes from a large holding in both Vertiv and argenx, which were trades that were executed either last semester or over the summer. Since I believe it was July. Since July, Isaac executed a trade for argenx, which is now up over 80% since that trade. Moving on to Core, it's continued to struggle since our previous ISM at 4% of relative underperformance. Since inception, the fund has now fallen to a negative 5.1% or a 3.9% of underperformance on an annualized basis. I would like to note, however, that as of yesterday, the fund is only underperforming by 1.5% year to date. So we look to see some improvement as we close out the year. And finally, the value fund has had a massive resurgence in its down stocks in the last 3 weeks, with 8.6% of relative outperformance. Since inception, the fund has returned 8% and on an annualized basis, 6.3%. This growth primarily comes from two stocks, a large holding in HCA Healthcare and Caterpillar. Now let's move on to our top performers. While I think it may be important to talk about it, all 5 of these stocks have consistently been our top 5 performers in some degree for the last 4 ISMs. So what I would like to highlight instead is the fact that all 5 of these stocks are stocks that we have heavily researched and have had high convictions in since the start. In the past ISMs, we have had 1 to 2 stocks that were top contributors solely because we didn't hold them, which makes it look like some of our performance or outperformance could come from total flukes and just not holding it. So for once, we actually have all 5 of our top performers being active decisions by the Smile Fund. Since our last ISM, as you guys know, we executed a trade that increased our holdings of Apple and HCA, and also, which we discussed earlier this ISM. Since our trade on September 17th, the fund or the Shopify has returned 9.5%. And it is important to note, 9.5%. And it's important to note that the benchmark does not hold any exposure in Shopify. So the fund will have to continue to monitor the risk profile of the stock as well as the fund to see if this meets our goals moving forward. Moving on to Apple, we have decided to equal weight our position in Apple, which seems to be the correct move as it has returned 12.7% since our previous trade. Finally, HCA, also known for its top-notch research with the 2023 CFA team, has been a consistent #1 performer for the traditional fund for at least a year at this point. And we decided to up our position due to its high-quality earnings. And of course, that has also been a great move, returning 16.6%. We have a similar situation, which is that the benchmark only holds 0.13% exposure to HCA. So we do need to watch out in case of any shifting consumer trends or even facilities trends in the healthcare sector. Now, at the last ISM, I was asked to break out a little bit of a longer performance on the traditional fund in particular. So I've decided to break out 3 years for us. The reason why I chose 3 years is because if you remember, some of you may have been freshmen, but ChatGPT was announced in October of 2022. For a couple years, the fund has been primarily AI contrarian, and that has burned us in the past. However, I would like to point out that despite being primarily AI contrarian, we've only underperformed by 2.5%, which goes to represent a very unique skill that the Smile Fund has, which is its ability to find value and high growth stocks outside of the AI industry. This will be more, come back to this. This will be more important for the rest of our ISM, as both our VP of Macro and VP of a higher AI allocation. Additionally, I wanted to highlight our summer breaks, which has been a constant pain point in the fund. Over the summer, we usually are a little bit more inactive, either through the transfer of presidency away from the lab. The fund is committed to finding ways to increase either our trade quantity or increase the on a year-to-date perspective, we see that the fund has underperformed by 1.1%, with a high deviation away from performance during the summer. This actually represents our highest deviation And finally, on a semester basis, the fund has actually outperformed by 30 basis points. And this is HCA and Apple. And we are we are committed to using these returns and making sure that they actually stay in the fund this time and we don't lose them. And I'll now be happy to open the floor to questions, either to discuss total performance, any current trades that are in the works, or our policies that we are implementing. Thank you.
Any questions for Caden? You can always ask towards the end as well if you'd like. Going once, going twice. Okay.
Can talk loud enough that the whole room can hear me, right? But so my question was, you mentioned being fairly heavily in Caterpillar and that was doing well. What is the expectation in terms of tariff policy for Caterpillar? Because I know a lot of they bring in a lot from China. They do a lot in the U.S., but Brazil, China particularly.
Dylan, do you want me to answer that? You are the PM of Value.
Or I can hold it till another section. If
No,
that's
it's
more
fine.
appropriate.
We don't have a dedicated section for value funds, so I'm happy to answer it now. The thesis around Caterpillar has been that, yes, it is exposed to tariffs, both through just the raw materials they need to produce their product and also as they're exporting and importing these big machinery around. However, we've seen that they really haven't been quite as effective as we would have thought. They've still performed fantastically. We originally bought into them as kind of a defensive hedge since we thought the economy was going to slow down. There were going to be some slowdown effects, and perhaps construction could be an opportunity to kind of capitalize on. But even with the economy kind of staying moderately smooth, we've had a great chance to capitalize on the growth there as well, as new roads, new schools, new buildings need to be built. So it's really downside and upside protection. That tariff isn't quite as much as you would think.
What is your thesis going forward in Shopify?
So primarily, a lot of the share appreciation, at least in the last 2 quarterly earnings reports, actually been through increased demand from Shopify themselves. They've projected higher demands. I've always believed in arguably one of the better ones I've seen. There's nobody in the space doing it quite like Shopify, especially with how they break out their payment structure, which almost encourages people to go into longer term subscription plans over the monthlies. It just seems to be a very strong business model that isn't going to be eaten away anytime soon by any new competitors. So that's kind of our thesis on it.
All right, let's go ahead and move on to what's always one of the most fun parts of the ISM. It's the guaranteed market outlook by Thaddeus. All right, now it looks like for the first time ever, risk management will go before the market outlook, keeping you on your toes.
There you go. Yeah. For those of you that know me, I've held several positions here. I'm Dylan DeHart. This is my first time acting as interim VP of risk management. So don't pull the punches, and I'm happy to talk through our performance today. So good afternoon, everyone. We're going to look at the risk outlook for the Smile Fund. So according to the custodial count, the traditional fund has returned 16.42% on a year-to-date basis, while the S&P returns were 17.52% in the same time period. This constitutes a 110 basis point underperformance relative to the benchmark. Notably, this as of our ending beta was 1.03. It's slightly higher than the last time we saw you at our last ISM. And of course, over the year, we've had an average beta of 0.99 as well. While our average beta over the year has been 0.99, these two metrics, along with the risk-free rate, yield the traditional fund a Treynor ratio of 0.16 versus the benchmark's 0.17. Our tracking error of 3.69% was calculated by measuring the standard deviation of our daily 5-year returns from the benchmark and the traditional fund. Overall, year to date, we've had moderate underperformance on a total return basis and minor underperformance on a risk-adjusted basis. On to our sector allocation versus the benchmark. So currently, we are significantly underweight in 3 sectors: consumer discretionary, industrials, and materials. Our reason for being underweight in consumer discretionary is due to our cooling consumer thesis and cooling consumption. Additionally, we are underweight industrials due to our focus on utilities amid rising energy demands. Within materials, we just recently sold out of Sempra due to our outdated research and lack of conviction within the space. However, it makes up a low weighting in the index and a small contribution to return. We do hold a few significant overweight positions in financials and consumer staples. These positions are driven within financials by our conviction in Berkshire Hathaway, and our overweight in consumer staples stems from our confidence in Walmart to capture both high and low income individuals. Notably, I can also announce that we're finally overweight information technology after some recent trades. This move was made to improve our performance across the sector. Alrighty, on to our top 10 holdings by ending weight year to date. 3 of these names are not in the benchmark's top 10 holdings, those being HCA, Walmart, and Raytheon. This indicates our significant active weighting in these positions. Additionally, I'm proud to announce that among our top 10 holdings in the traditional fund, none of them have been negative contributors to return, with Microsoft having a neutral or slightly positive return. Our highest contributors to return within the top 10 have been Google, HCA, and Raytheon. And our top 10 holdings in the traditional fund now account for 54.05% of the portfolio. Cumulatively, these holdings have contributed 557 basis points to our total return. Looking at our top 10 holdings across the entire Smile Fund, excluding the strategic fund, it's a very similar story. There are 3 of these holdings that are not in the S&P 500, notably Walmart, HCA, and Vertiv. I'd like to mention Walmart is 14th in the benchmark, HCA is 105th, and Vertiv is not in the benchmark at all, indicating our significant bets against the dominant positions in the benchmark as well. It is worth noting that Google is now our largest holding across the entire fund, as we hold significant allocations in both the core fund and the traditional fund. And our top 10 holdings across the fund now account for 37.97% of our allocation. Moving on to our 2025 attribution summary for the portfolio. In total return, we had significant outperformance in a few sectors: consumer staples, financials, and healthcare, due to our continued strong research in companies like Walmart, JP Morgan, and HCA. Our allocation effect, however, underperformed the benchmark by 0.96%. This underperformance was primarily driven by our overweight position in consumer staples and underweight position in IT for majority of the year. Looking at our selection effect, our strongest performing sectors were financials and healthcare, with standout contributions from JP Morgan and HCA again, while our least performing sectors were industrials and information technology. This is because of us holding Vertiv at the beginning of the year and Salesforce having slow growth and lagging AI adoption, something I'll talk more about in a moment. Our top performing sector in total attribution was healthcare, with our lowest performing sector being information technology. Overall, on a total attribution front, we underperformed the benchmark by 0.54%. This was largely due to our poor selection within industrials and the IT sector. Next, I'm really excited to talk about our style report. So our style report looks at the approved list and current holdings within the traditional and style funds. And notably, as of now, our approved list contains 154 companies that remain active per our guidelines within the IPS and are categorized via Morningstar's categorization system. Across the traditional fund and style funds, we now hold 46 unique equities, with majority of them being classified as core stocks. I'm excited to announce that we have a few stocks we're researching in each category this semester. They're going to be really exciting. First and foremost, a name you all know, Unum, a value stock that specializes in disability and risk insurance. Cencora, which is a pharmaceutical distributions and solutions company. And lastly, in the growth sector, we're looking at Energy Fuels, a US-based company that primarily focuses on the production of uranium. On to the main risk to performance. Within the traditional fund, as of October 31st, 4 of our 5 lowest relative contributors to return come from the IT sector. Vertiv being the standout item here, I'd like to mention. While not in IT, it was an AI play for us, and due to its database cooling segment, its not negative contribution to return comes from our loss that we suffered at the beginning of the year within the traditional fund. And notably, I'd like to say we currently hold 0 allocation in the traditional fund, but in the growth fund, we still hold an aggressive allocation, which is still outperformed on a year-to-date basis and has offset this loss quite a bit. Looking at our IT sector, we hold a few holdings here. Significantly, Salesforce. Salesforce is a big component of why we've had negative contribution to return within the sector on a year-to-date basis, because they've undercapitalized on the future return expectations, and they have a slow adoption of AI, and investors don't love that currently. We're working on a trade request to lower our allocation in Salesforce as our thesis has changed in the space. And looking at these 3 other holdings, Palantir, we currently do hold an equal weight position. However, we just received a fantastic report in exec, and we plan to trade on that as well. Looking at AMD and Micron, one of the stocks we'll be talking about in a little bit. These stocks are something that we didn't hold any allocation to on a year-to-date basis, but have contributed significantly to the return of the benchmark, and thus have given us negative contribution to return. We were working really to reevaluate this space as we recognize the portfolio has lagged the benchmark in total return significantly, but because of our IT selection effect. One of our main goals over the coming weeks will be to realign our IT as we think that's where we'll improve the most. We're really excited also to announce that within the IT space, we've been able to get 2 new professional mentors, being Dr. Bouchard and Dr. Butler, that can provide valuable experience and guidance to us over the coming months. Looking at our second risk to performance, there's a few points I'd like to make here. Within the traditional fund, we now have a 54% allocation to our top 10 holdings, with a majority of these being plays in the AI space. This concentrated approach year to date has had a strong performance for us, but there is growing dependence on large cap tech and AI-driven companies amid ongoing uncertainty and volatility in the space. I'd like to now take a moment and show you a visual that Bloomberg recently published that shows the recent surge in circular alliances across cloud providers, chip makers, and software providers. While this opportunity does present itself that it can boost innovation, we do see risk with it blurring competitive boundaries and raising overall systemic risk. In the short, overall, I see 2 main risks to this movement. In the short term, there's an ongoing uncertainty around the timelines of AI, particularly in its ability to have a return on investment for major stakeholders. In the longer term, there remains to be seen, there remains uncertainty around AI's grapple with steep infrastructure cost, speculative returns, and tightening regulatory oversight. Given our overweight position in major AI names, officers are reassessing risk profiles to ensure that our return expectations align with our current risk appetite. To wrap up, based on our current positioning and operational processes, we acknowledge IT selection as a key performance drag this year. And thus, we are working to actively mitigate this risk through realigning the sector, through potential divestments, and working with our new industry peers to gain insight into the space. Next, we remain cautious of heightened AI-driven volatility and concentration risk. One of the things we're doing to mitigate this risk is continuing to stress test our top holdings, really to refine our valuation assumptions as the landscape evolves, particularly given that now our traditional fund holds over a 50% allocation to some of these names. And finally, while the fund continues to generate strong, well-supported research, we've historically encountered challenges maintaining momentum over the summer. We're addressing this risk by enhancing our idea execution over the break. Looking at the traditional fund and style funds, we've instituted new trade timelines to ensure portfolio managers act accordingly and can react to current news. Thank you. I will now open the floor to questions.
Do we have any risk management questions? Okay, there we have one up there.
Hold up. I can't hear you.
As the interim VP of Risk Management, how have you responded to geopolitical tensions and market volatility?
So that's a fantastic question. One thing I'd like to highlight is within our current holdings, we hold a kind of over concentration in the Mag 7, excluding Tesla for the most part. And that's the stance that we've had for a while now. Geopolitical tensions, especially tariffs, which I know Thaddeus will talk about in a second, are an ongoing concern. At this point, and where we're at on the portfolio management side, we believe that these large players are the space to be in, particularly given that AI is still a dominant theme in the space. Unfortunately or fortunately, AI is very capital intensive. Small players are at a unique disadvantage in the space. So these large players that have massive cash outflows and inflows can really become dominant and just provide that stability that we're also looking for. But we really truly don't have a ton of external tariff pressure that we're just taking crazy risk. It's all very mitigated.
Any other risk management questions?
Maybe two parts, if you don't mind.
Yeah,
One, how do you think about valuations? Right now, the stock market's hot. It's been really hot, but it's also really hot. And so, like, when you look at each company, when you look at a sector, how do you look at it relative to its historical average? And then part two, how do you stress test sort of your positions in your portfolio? Like, if there is a 10% correction, a 20% correction, like, how do you think about that?
Yeah, that's a fantastic question. Particularly with the circular flows we've seen between these massive AI companies, that's something that ultimately does raise the premiums assigned to these companies. So currently our stance is that we recognize things are trading at a historical premium. And really what we're doing to monitor that is working with discounted cash flows, different model valuation models to understand where are these assumptions coming from. And if they are outside of our risk appetite, is it something that we can maybe shift out of the space and into something a little more within that scope? So for instance, we really didn't have the risk appetite for Vertiv in the traditional fund, but through leveraging it in the growth fund, something that has a bit more riskiness to it, we're able to leverage it and kind of wait through the drawdowns. So playing that through the portfolios as well is important.
Regarding, just to answer that second portion, regarding the stress testing, we do not have anything yet. However, we are working with our VP of AI and automation to develop sort of a doomsday portfolio in case any sort of large shifts in market sentiment does happen. So just to answer that, we don't have anything yet, but we are working on it.
Hey, Dylan. Dylan, nice presentation. Can you go back a few slides? There's one, I think, where you look at the portfolio weights across all of the
across all the funds except strategic.
Yeah.
This one.
Right. Okay. My question is, one of the concerns that we raised when we went with these additional funds was the monitoring and management of overlap. So the duplication and such that in the aggregate, you want to be mindful of what your exposures are. So I guess my question to the officers would be, if all of the funds were invested in cash today, would you go out and buy a 7% position in Google in the context of what you were arguing? I mean, one of the concerns about AI is obviously the CapEx.
Mm-hmm.
The expectation is that they'll probably rely on some form of an advertising-driven revenue model. It's really the only way that works. And there's been a number of initiatives by ChatGPT recently to get into more ad dollars. That would more than likely displace Google more than anybody else. And so my question is then, if the answer to my question is no, you wouldn't buy a 7% position in Google, how do you guys manage this from a risk perspective? Because Google is actually your largest risk. You presented other companies, but Google is your largest risk.
Yeah, I think that's fair to say. The style funds, I will say, hold a unique advantage of, I think in a perfect world, we'd have our complete story aligned. But the purpose of the style funds is to give us some room as an additional portfolio to take those additional risks that maybe we wouldn't have the appetite for in the traditional fund. I do think we have a very, very aggressive allocation to Google. Our core portfolio manager has said that he's very convicted in this space, and I think as long as that fits his risk profile, it's okay. It is one of those things, though, that with it currently Alphabet, for instance, in the core fund is I think about a 40% allocation. So notably for the portfolio size, about 320,000. You want to talk? Yeah, go for it.
Yeah. So just on that Google side, we do have a very large allocation in Google in the core fund. Sorry, I'll introduce myself. I'm Bryce Keckley. I'm the manager of the core fund. We do have that very large allocation that did come from, that was mostly temporary, as we did have a trade fall through with EA because they were bought out. So that is something that we will be working our way out of and mitigating our exposure to in that portfolio. So we will have a little bit of decrease in total weight across the entire fund, but overall, we do still believe that Google is a very, very good selection.
I'm not questioning Google's presence. I'm just saying it's your largest position, and I believe that's overweight the index substantially.
Yeah.
One other question, not to monopolize it, but the one with the slide with the tracking error. Yeah, the math doesn't seem to add up for me. And I know that the tracking error, we're comparing a bit of apples to oranges here, but I've been coming to these for so long that the betas average somewhere between 0.98 and 1.04. The tracking error, given how tight you all are to the index, strikes me as a little bit high. And you use the PORT function in Bloomberg to generate these numbers, correct?
Yes. So we pulled the 5-year daily return for these out of Bloomberg, and just calculated the basically difference between the portfolio versus the benchmark, and then standardized it. And this is kind of what we got kicked out of the formula.
Okay, so the PORT Bloomberg, yes, automatically load the portfolio in and generate it.
Always encourage us to kind of calculate ourselves, as Bloomberg does do some very basic calculations. So I made sure to check that, and it was within very close to Bloomberg's.
Okay, still then brings me back to my point is there's something about the tracking error that suggests to me that your downside capture is greater than your upside capture, meaning when the market's down, you're down more, and then when the market's up, you're up less. And I think that the PORT function does give you that. And I think it's worth, from a risk management standpoint, exploring why that is, because it suggests that in a down market, this portfolio is going to underperform much more than you all might expect.
Ray, we'll get that looked at and we'll get you the answer. It could be, I don't know if cash drag might play a role there as well, or if Bloomberg versus patent numbers are somewhat different as well. We'll get you that exact answer. Okay, with that being said, we're going to go ahead
Dr. H.
and
Dr. Mullins?
Oh,
I've been
one more. Okay.
waiting. Multiple people.
There you go, Deborah. Go ahead.
All right. I know that this is no surprise to the healthcare or to the officers. You're overweight in HCA when you're adding, and then in value fund, you've also got a lot. That given the federal policy and the changes in insurance, not only for the commercial, but Medicare and Medicaid, that they are likely to see some hard times coming in 2026. So how are you gauging the risk in that industry, particularly with that one? Because the other stocks that you hold in healthcare are not as immediately impacted by federal policy.
Yeah, it's a fantastic question. I think this is the perfect thing to speak on since I'm the chief of healthcare. Love the question. So currently, I'll say half of this exposure, roughly about $50,000 of it, is in the value fund. Currently, I manage that. My intention within that, and really our broader theme, is I will be trimming that position very shortly. It's very much it's a safe haven currently, with the president throwing around different policies around tariffs, around taxing pharmaceuticals differently and raising and lowering prices. It's a very rocky space to be in right now. And in the near term, HCI, I believe, is the right option. Long term, we're going to face risk. We're going to face more uninsured people, which is going to decrease margins, and it's ultimately not going to be the best space to be in. We're working on rotating out of that, at least in the value fund. And I'm sure we're working on reevaluating how we can take the traditional fund still in a good sense in healthcare, but not be as exposed to those other tariff or pharmaceutical or taxing risk. But it's very temporary and short term. Well, thank
And
you.
they've got a lot of research in healthcare coming out too. So I think they'll be able to make that happen. Okay, with that being said, just try to keep us on track. Let's get to an exciting portion on market outlook. Hopefully his numbers haven't changed in the last 10 minutes. Thaddeus.
Thanks for getting me caught up, Dylan. All right, hello everyone. Thank you all for coming. For those of you that I have not had the pleasure of meeting, I'm Thaddeus Weiss, the VP Market Analysis. Today I will be discussing a Fed policy recap and how we think the Fed is going to behave moving forward. I'll give a snapshot of the current state of the U.S. economy, as well as our near future expectations. And then I'll finish up by highlighting some of the research that the Dream Team has received in our first round of True Reports. So starting with Fed policy, at the last Fed, I'm sure many of you know, there was a 25 basis point rate cut, but there was some amount of uncertainty about whether or not there's going to be another rate cut before the end of 2025 and how many there will be in the first half of 2026. Fed Chair Powell made it clear that it was not a foregone conclusion. So again, the main goal of what is the Fed's role right now is being called into question, whether that's inflation management and financial stability or job creation and being a supporting agent for the economy. One thing that I did want to highlight is that quantitative tightening is coming to an end on December 1st. Now, it's important to note that an end to quantitative tightening does not mean that there will be an immediate start to quantitative easing. That'll likely come after rates are slightly lower to be able to accommodate more purchases from the liquidity injections into the economy. That does lead me to believe that there will likely be more rate cuts at least somewhat soon, just not guaranteed to be immediately. But again, the key narrative is that we're going to have to pay attention to Fed policy in the near future to truly be able to decipher what their role is going to be going forward. Moving on to the first major indicator that I wanted to cover. So again, recent Fed policy that has been somewhat restrictive has pulled down spending in many interest rate sensitive sectors and business investment as well. This has put a drag on overall GDP growth. Although consumption has remained somewhat resilient, still though with resilient consumption, the pass-through effects of tariffs, along again with the somewhat restrictive Fed policy, have hampered consumption from being as strong as a component of GDP as it is historically. In addition, trade uncertainty and the risk of foreign retaliation against our trade policy in the U.S. has discouraged long-run capital expenditure plans by U.S. firms that heavily rely on global supply chain. This has also contributed to somewhat suppressed investment. Not totally, I'll cover that in a second why, but as well as a cooling labor market. I also wanted to highlight total GDP growth compared to AI-related investment and spending. So I've got three different estimations here, and obviously the percentages are different. That's a result of how they netted out imports and how they categorize AI-related investment and spending. But as you can see, the consensus is that on a non-annualized basis versus quarter four 2024, AI has contributed a significant amount of growth to total GDP from anywhere from about a third to 2/3 of total growth. And one thing that I would like to pay attention to is the slowing job creation, the cooling labor market. If that does somehow have a connection to AI-related investment causing it to slightly slow, I believe that could be another drag on total GDP growth in the near future. Moving on to unemployment. Since the last ISM, we've seen a couple of interesting things happen with the unemployment rate. So for those of you that were here, you may remember that the current full employment range at that time was 4.7 to 5.8%. Since then, there has been a downward revision in that range. as well as a slight uptick in the unemployment rate, which has now moved us into the full employment range. Although this slight uptick is going to relieve a little bit of wage pressure on U.S. firms, it is now it's theorized by economists now that in the full employment range, unemployment will have the most minimal impact on inflation that it could. We'll have to see if that's true going forward, but that is the general consensus. I also wanted to discuss a little bit about the actual job quality of private sector jobs in the U.S. currently. So as you can see, I'll explain what the JQI is first. So this is basically an index that measures the quality of jobs in private sectors in the U.S. of all non-supervisory roles and all production focused roles. So jobs that are labeled as high quality are above the average weighted weekly wages. Jobs that are low are below the average. So as you can see, the job quality in the U.S. and private sectors is somewhat cyclically decreasing right now. But what I wanted to highlight was that when you overlay this data with real wage growth, they kind of seem to be contradicting each other right now, because the average real wage growth is still positive. It's been positive nearly the entire duration since the beginning of 2023. This is going to be important in keeping consumption at least somewhat resilient moving forward, which obviously means that it's going to be important in keeping GDP growth at least somewhat incremental and consistent. Moving on to inflation. So as you can see, the current CPI rate is persistently above the Fed's stated rate, and it is expected to jump up a little bit as we move forward. The Fed's somewhat restrictive policy has likely been a factor in keeping it from going to elevated levels that we've seen in recent years. But one thing I did want to highlight is that I believe due to inventory stockpiling methods, as well as a multitude of factors relating to trade, I believe tariffs are going to cause a slight structural bump in prices within the next few months. Economists estimate that about 80% of the price bumps from tariffs will be passed on to consumers, which is important to note. In addition, slowing labor productivity combined with slowing job creation, in addition to real wages that have been positive and still increasing, I believe this is something that I came up with by myself. So please take this with a grain of salt. I could very, very much be wrong, but I wanted to share this thought. If we are experiencing a slowing labor demand, slowing labor productivity with rising wages, that could potentially mean that unit production costs are increasing. If that is true, we may see another ever so slight price bump from producers in order to catch up and offset those increases. Lastly, I wanted to highlight a trend that has kind of flipped in the last few months. So food and energy price volatility has somewhat increased, which has allowed food and energy to kind of regain their importance as CPI drivers. And although this on the surface does sound like a potential danger for goods in those that relate to those prices, I believe that because energy and food do have somewhat high inelasticity of demand, that this may be a place for potential growth in investments in an uncertain economy. Moving on to non-farm payrolls, I obviously needed to talk about the labor market in the current situation that it's in. So after very, very extreme levels of hiring during and post-COVID, we are seeing a job creation reset. Downward revisions have confirmed that labor demand is significantly decreasing, especially in industries that are exposed to trade risks, such as manufacturing and wholesale. In addition, policy-induced uncertainty, whether that's, again, tariffs or just us not being totally sure exactly what the Fed's role is going to be going forward, has contributed to U.S. firms, many U.S. firms having unusually high layoffs in recent months. Something that I thought was interesting when compared to the slowing labor market, though, was the retail trade sectors in the U.S. As you can see, sales are still incrementally and steadily increasing, as are inventories. This represents that real wage growth has likely that real wage growth is a likely reason that sales are still increasing. But I also wanted to highlight, although inventories could be signaling that U.S. firms are confident they'll be able to still sell goods to consumers in the near future. This could also be a sign that firms are continuing to stockpile inventory in the face of constantly changing tariff rates, or it could also mean that firms are not able to accurately predict what consumers are going to purchase, which again would reflect struggling and hampered consumption. Transitioning over to the housing starts indicator. This is an obvious sign that restrictive Fed policy, or somewhat restrictive Fed policy, excuse me, has contributed to slowing in consumption of durable goods. Although this is obviously only talking about homes and residential goods, this is a good indicator that interest rate sensitivity has exercised itself and that it is proving to be true. Again, so sticky borrowing costs have likely hampered consumption. But I did want to highlight that despite the fact that residential construction has been struggling in recent months and is expected to going through the first half of 2026, non-residential construction spending has been very healthy recently. And believe it or not, this is likely due to AI-related construction. So whether that's data centers, AI infrastructure, new nuclear plants that are going to be powering these data centers, or anything else related to it. That's, as we covered in the GDP slide, a major contributor to much of the growth in the economy currently. Now, I wanted to give an update on tariffs. One thing that I wanted to highlight is that although tariffs are inflationary in the sense that they cause an increase in the general price level of goods, they're not inflationary in the sense that this is a price level increase over time. So tariffs cause a one-time structural increase, theoretically. With our tariffs, as you, I'm sure, know, the tariff rates are not typically consistent currently. So that has really complicated forecasts for tariffs and for the overall level of increase in prices. In addition, they're a very complex situation because tariffs are price increases due to non-natural forces, so forces that are not in the market. There are supply side shocks, so slower growth and slower spending contribute to higher prices. I also wanted to highlight that the average effective tariff rate, I am not sure what happened to my slides there. I apologize about that. But I wanted to highlight that the average effective tariff rate pre and post substitution in the United States is very, very similar. It's not expected to, tariffs are not seeming to actually be accomplishing their goal currently, which is increasing the trade balance, strengthening the dollar, and raising net exports. In fact, after substitutions, which for those of you who don't know, substitutions are essentially the reshoring of operations and supply chains by U.S. firms. Some of this is actually increasing after substitutions, which is very strange to me. I'm assuming it's due to, again, the uncertainty of what future tariff rates will be. But I also wanted to highlight that the stickiness of tariffs themselves has been evident in the recent history of our political landscape. So after the first term for Trump's administration, about 90% of the tariffs that he enacted were actually kept by the Biden administration. There were even some new ones added. I wanted to highlight that the impact of tariffs on GDP, which is projected to be negative, is likely going to last even after the current administration is out of office. Moving on to our recommendations for sector weights moving forward. IT and communication services should be areas for growth in an uncertain environment for two reasons. These sectors are, again, the primary beneficiaries of AI development and AI spending. And this only pertains to communication services. But if you were at my last ISM, I discussed how the communication services sector is integrally defensive in about half of its sub-industries. And this provides a buffer against uncertainty. The same could also be said for industrials. And I understand that that may be a surprise for many of you. I did want to highlight that the recommendation to decrease weight in industrials is industry specific, meaning that I'd like to highlight that industrials related to AI development, investment, AI infrastructure, data center construction, those are all still going to be great. But a lot of companies in the industrial sector are also very, very open to geopolitical risks, especially tariffs. Financials, energy, and REITs are all in very similar situations. I believe parts of these sectors do have niche areas of growth, For energy, I wanted to highlight things like nuclear energy, natural gas, liquid natural gas, U.S.-based energy firms where all of their supply chains are housed here. Amid the current push for energy dominance by the current administration, I believe that those are good opportunities for growth. With financials, large banks and other financial institutions should be the primary methods of financing future growth in AI-related development and just other developments in the United States in general. So I believe that that could also be a niche area for growth. REITs, on the other hand, I wanted to highlight that I believe many of the properties that could be related to things like defensive healthcare sub-industries or, again, AI-related real estate could still present opportunities for growth. Consumer discretionary and materials are both facing significant adverse headwinds right now. Because of that, I believe that they should likely be underweighted and potentially move towards sectors such as consumer staples and utilities, which are both integrally defensive and could provide sort of a safe haven for investment during an uncertain time. And I wanted to say the same thing about healthcare, which I believe, again, like Dylan said, in the very near future could be seen as a safe haven. However, I also wanted to just echo what Dylan said. Sub-industries such as pharmaceuticals are under intense scrutiny, whether that's from tariffs or from the FDA or other, government regulations. So that is something that we'll have to pay attention to going forward. Moving on, I will now begin to highlight some of the Dream Team's research from our true first round of reports. For those of you who don't know, so it stands for the Dedicated Research for Emerging and Advanced Markets. So instead of investing in companies, we invest in countries. And I wanted to highlight some of the research that we had because I thought it was very, very well done. So the first country that I'd like Poland's financial sector, albeit smaller than other European countries' financial sectors compared to GDP, is extremely modern and extremely efficient. And it's been a robust engine of growth for Poland recently. This sector's stability is going to be crucial for financing growth, especially in small and medium-sized enterprises in Poland. In addition, geopolitical tension and conflict in Eastern Europe has, as well as global supply chain fragility, has kind of popularized the trend of nearshoring in Europe. Poland has become a primary beneficiary of these developments, which provides an avenue for economic growth. In addition, Poland has kind of solidified its role as a logistical hub for NATO. Again, this increases defense spending for Poland substantially and has created yet another avenue for economic growth. It's all evident in the graph I've included on the right, which shows the return of ePol, which is the ETF that tracks the Polish economy based on the benchmark that we use. It's had incredible year-to-date performance, and many analysts are expecting this trend to continue. Moving on, I'd like to discuss. Sorry, I should have said this, by the way. We're increasing our weight in Poland, if that wasn't obvious by what I was saying. The next country I want to highlight is Germany. We're recommending that we decrease our exposure to Germany for a few reasons. Germany is in the midst of an energy price crisis, as well as an aging population, which is becoming less skilled. Their most historic industries, such as automotive manufacturing, chemical manufacturing, and industrial sectors in general, are feeling the effects of higher production costs. It's very evident by the fact that they've been struggling recently. And the interesting thing about the German economy is that these sectors and industries are so historic in Germany that their financial sector and their broader economy are suffering from a lack of diversification to other high ceiling, high growth sectors such as technology. So that's led to the financial sector struggling as well. Consensus forecasts are seeing the German economy experiencing very, very slow stagflation-like growth, near zero growth in the future. And then I wanted to address a stimulus package that Germany had received that many people may assume is going to provide a large avenue for growth. Due to the dispersion of that stimulus package over time and sector, the amount of sectors, we don't believe that it's going to provide enough growth over our forecast period to justify increasing weight currently. Moving on to the last country that I wanted to highlight, we have the United Kingdom. The United Kingdom's financial and tech sectors continue to be robust engines of economic growth for the UK, with London remaining a leader in financial markets and entrepreneurial ecosystems globally. The UK has been in uncertain economic times recently, but they are expected to experience a soft macroeconomic landing with subdued but persistent GDP growth, stable unemployment, and although it is higher than desired, inflation that is falling. This stability to us painted a picture of a potential safe haven for foreign investment in a time of global uncertainty. This was even, we also like the fact that they're in the middle of a monetary easing cycle. This provides another avenue of growth for investment to bounce back and in turn consumption. In addition, the UK has remained the second highest recipient of foreign direct investment in the world behind only the US globally. So to recap, we discussed how the Fed going forward is going to have to choose between two roles yet again. Will they become a supporting economic agent with fulfilling their goal of improving job creation, or will they focus more on inflation management and financial stability? In addition, we discussed how a slowing and uncertain economy, we believe, still offers niche areas for growth in defensive sectors and niche sub-industries. And then we also highlighted an overhauled Dream Team's first round of research and how it's going to usher in a new era of foreign investment for the Smile Fund. With that, I will open up the floor to questions.
Can we go ahead and give him a round of applause? That was a lot of information. Okay. That may have been too much information. So we'll revisit that for the next
I
item.
cut out 3 slides too.
I bet you did. Okay. We'll take a couple of questions here. We're not going to take as many as we normally would. I would like to remind everybody, we have one more presentation after this. I know it's hot. We should be selling Cokes and making millions of dollars or something like that. But we do have the invitation to UJ's, and if you did get an award or you got a cord, please come down afterward for some additional group photos. That being said, I'd like to take 3 or 4 quick questions. Deborah had her hand up first, and then I'll go to Dr. Saul next.
Just a quick request to the Dream Team. If you're going to do 3 axes on a graph, please label them.
That was,
Because
I
it's-
designed all these slides. I'll have to take the responsibility for that. Not the Dream Team. That was me. Right. Thank you for that. I'll consider that moving forward.
I got 2 questions. So the first one, you in some of your slides, you said that there's real wage growth happening, there's retail sales going up, but in your investment thesis, you say that you're not bullish on consumer discretionary. How do those things work together?
So I think it's important to highlight the fact that the labor market is struggling very, very, very. It's not doing well right now. So despite the fact that maybe per consumer consumption is doing well due to like real wage growth rising, the holistic effect of a slowing labor market is that there's not going to be as many consumers with disposable income to be able to create a strong environment for consumer discretionary. And that's why I thought consumer staples would be a better safe haven for investment currently.
Okay. The next one is, what are your views on you touched upon housing starts and all those things. Now, recently, I think yesterday it came out, they're coming out with a 50-year mortgage and stuff like that. What are your views on that kind of policy, and how will that impact the housing market?
Yeah, so from what I've seen, there's been a significant amount of government initiatives to try and increase housing affordability and residential construction. I am not at liberty to give you a full prediction. I'd like to do some further research and get back to you on that because I want to make sure I'm not giving out false information. But what I can tell you is that I don't know how effective those initiatives are going to be until the Fed really brings rates down a little bit, because they're still being held at what could be considered elevated levels. So I'm not sure if durable goods purchases will be able to bounce back until those rates come down a little bit. And again, I think the end to quantitative tightening could be a sign that the Fed really does want to move towards more of a supporting role in the economy. I'm not saying that they have to. I just think that it would help with durable goods purchases bouncing back if they were lower, because then it would be financing would be cheaper. But it could bounce back without rates being cut. It seems more likely.
Thaddeus, that comment, actually, I'm going to reverse my questions. Can I go to your first slide?
The Fed slide.
Yeah.
Yes, sir.
Okay, so those are cumulative rate cuts. So in 2027, the Fed's going to start taking the rate cuts back. So they're going to be tightening.
Right.
Okay. That doesn't seem to align with your views, because they're either going to raise rates
Mhm.
because the inflation impact from tariffs are not one time,
Right.
or wage inflation increases, or I mean, there's something that's going to cause them to take back. Can you speak to that? And I guess, I mean, yeah. So I guess I'm trying to understand then. You've got the slide on the right arguing for greater liquidity.
Mhm.
And then the slide on the left indicates they've got a couple more rate cuts, but then they start tightening. So, right.
This is from Bloomberg, the world interest rate probability function.
So that's what the market's priced in the
Yes.
forward and in the
Yes.
futures market. Yeah.
Yeah.
So what do you do with that information?
I believe that probably a product somewhat, again, of like the just uncertainty that's been presented at Fed meetings recently, with kind of contradicting, not contradicting, but clashing verbiage.
Yeah, no. What I'm saying is I'm less interested in as to how or why,
Right.
your hypothesis as to how it gets there. What I'm saying is if that's right,
Mhm.
if the market's right, and if the Fed's going to be raising rates, how do you interpret that in the context of your outlook? Because the rest of your outlook doesn't seem to conform to that. Do you see the contradiction?
Yeah, I do. I see what you're saying. And I thank you for highlighting that.
Yeah.
Let me look at something real quick.
Well, and if you'll take me to the slide with the arrows.
The slide with the arrows. Oh,
Yeah.
sorry.
This dashboard thing you've created. Correct. Right. So to the officers in just general, that's my second question. This is a top-down view, economically driven, right?
Mhm.
So as an advisory board member, if you present this to us, then the next time we see an ISM, your trade request should conform to this, correct?
Yes, ideally. Again, we're in a really uncertain environment. So, in a couple days, or maybe not a couple days, but in the near future, this could potentially not be.
But we can't do that.
Right.
So
Right.
you
No,
can't-
I
You
agree.
can't do that.
Right.
You're putting this out there.
This
And
is.
you're saying that this is the appropriate direction of the fund.
I believe so currently. Yes.
So you're informing the audience that this is what the fund should do.
I believe so. Yes.
Okay. So then if you don't follow through on this, then what's the purpose of this slide?
That's an excellent point.
I'd also like to point out that we do now have a top-down fund, so some of this will be done through ETFs and on the strategic fund side as well, but it should still be relevant for the bottom-up fund as they're making their decisions. So for those of you portfolio managers that are on the bottom side, you should still pay attention to this. You don't want to go contrary to this. I know you're looking more at the bottom-up research, but you should be paying attention to this. This is not just purely for the top-down fund.
Right. And see, all of this should align, right? So
Mhm.
for the team to act in unison, I should see the beta below 1, right? At the next ISM, I should see the beta below 1, right? And then, I mean, you're looking at based on the sizes of these arrows, you're saying you want to go aggressively in utilities. I would caution you there. I don't think utilities will be as defensive as they have been in the past. They've got tremendous pricing power, all related to this AI trade and demands for power that are exceeding available supply. So just want to throw out some things for you guys to talk about. But I would caution when you're this definitive on major, reallocations, then you're informing the board that's what you want to do. So we would expect to see follow through before the next ISM. Okay.
And I did want to kind of echo what Dr. H said. A lot of what I did during the first ISM was more focused on, specific sectors and industries and things like that. When I was crafting this, I'll admit, having more of the strategic fund structure in mind. Of course, investment decisions should still reflect this. But again, this with a down perspective, maybe a little bit more than I should have. So I will work on that for the next ISM.
Just coordinate.
Yes, sir. Of course.
I actually like it. I want you to have strong convictions and then test it through this crowd. So you having those those convictions is great. Just be ready to get feedback during the ISM and maybe even afterward and respond to it accordingly.
Of course. Thank you. Questions?
Any more questions for Thaddeus? I know that's a lot of information.
Research being done on the strategic fund now, so that's good to see. We may want to be thinking about some streamlined ways to examine countries and macro phenomena in that sense, so that we get it to where we want it to be.
Of course.
So well
Yeah.
done. Yeah.
Yeah, we're still smoothing out all the details of the overhaul. But Nathaniel Kroll is the portfolio manager of the strategic fund. I'm the assistant portfolio manager, and we've been working with Dr. Shungroth to kind of create a new era for it. But we received a very strong first round of reports. Some countries that we didn't have, or that I didn't present about, but that we got reports on were Hungary, Japan. We have one on China. Am I missing any, Nathaniel? Okay, so we had the strategic, or the dream team is still small, but we're growing. And yeah, as it continues to gain size and momentum, we'll have more structure and more streamlined pipelines for research. Yes, we do. So, how to describe it? So we hold one ETF. Nathaniel, double check me on this to make sure. One ETF that represents the U.S. market in all sectors. We're at weight there currently because we're still working on getting the domestic market research pipeline worked out to figure out how we want to decide what our weights will be. And then index that encompasses all developed markets, which I'm forgetting how many exactly are there. I think there's 13 or something like that. 33. Okay, I was off by a little bit. Sorry about that. But we currently hold one ETF that encompasses all of those. As we continue to get more research flowing in for specific markets, what we'll do is we'll trade into benchmark weights for all of those, or figure out what benchmark weights would be, and then we'll, for example, for Germany, we would undercut it or underweight it and use that extra weight to go towards markets that we're more bullish on, such as Poland or the United Kingdom.
Actually having positions in each of those
Yes.
countries and either under or overweighting them, right?
Yeah.
So
We.
Poland, for example, is probably part of ex-US, right?
Yes, sir.
Right?
Yeah. Oh, it's not. Okay, forgive me for that. But yeah, we switched benchmarks when we were going through this overhaul too. So that's why we traded into the one holistic ETF to start off with, just to establish what benchmark weight is.
And Thaddeus, and I'm not sure who you were pointing to.
Nathaniel.
Nathaniel, nice to meet you. You do all realize that when you go into a Poland fund, you're buying equities.
Yes.
Okay, so like when I look up EPOL and I look at the top holdings, I don't think I recognize any of those companies. How are you evaluating? I mean, it sounds like it's more of a top-down macroeconomic forecast. You like Poland as a country, you like the state of their economy. For whatever your argument is, that's fine, but it's still an equity fund.
Right.
So there has to be some sense of the contributors to that equity fund producing alpha.
Right. We are working on methods to actually go through distinct valuation methods. Currently, we're just doing it holistically on the ETF. But for each of these countries that we do invest in, we go for the ETF that tracks the benchmark that is the primary economic index of that country. So
Like,
So it's an economic, you're buying a country fund because of the economic prospects.
if I may butt in for
yeah,
a second.
yeah.
So that very much depends upon which country we're looking at.
Yeah.
Poland only has a single ETF, but Japan has 20. So we can also look at sector weightings between the different ETFs and see, if we think several specific sectors within the country are going to outperform the country as a whole, we can choose an ETF that overweights those sectors.
Daniel, and thank you, Thaddeus. Okay, if you can hold with me, we do have an awesome presentation on Micron. It's our last one. If you have to go to class, if you have to leave, I understand. Please do it right now. And we're going to have one more exciting presentation for you guys. We ran a little bit longer than normal, so I understand if you have to leave, but this is going to be a great presentation. All right. Thank you all. Can we have everybody please sit back down, and we'll have a really informative presentation on Micron. As you've heard it mentioned a couple times, this is a stock that they're looking at that is somewhat related to the AI space, but it's unique in that space. And it has its own unique reasons why we like it, even depending on what might happen with AI. So with that being said, Evan, give us what you got.
For coming today. My name is Evan Davis, and I'm going to be giving my stock report on Micron Technologies, which I give a buy rate of 200, which represents a 5% upside. I know that seems pretty low. How volatile the stock can be. For instance, since I last gave this presentation, the stock alone has gone up 20%. So I'm sorry. All of you to please keep your attention, since it's very interesting information. It's still a very... Who is Micron? No, it was not, sir. It was a buy. The previous buy rating, so the previous stock price when I gave that buy rating was $202. And when I did this valuation, it was at $200.
I would say his numbers are somewhat conservative, in my opinion, as well. You'll see through some of his presentation. And then also, like he said, with the volatility, we might not buy it right away, but if it does take a significant dip, and then we still like the underlying investment thesis, it could be an opportunity for us. So.
I find this. Okay, sorry. Switch with you. Hello? Oh, yay. Thank you, ma'am. Appreciate it. All right, but who is Micron and what do they do? Micron is a company that manufactures and produces high bandwidth memory from everything down from your phone all the way to the hyperscale data center. They also make data storage solutions such as NAND flash technology, though for the majority of this presentation, we'll be going over the high bandwidth memory for the hyperscale data center, since that is their highest margin, their highest profit, and it's also their highest growing revenue segment as well. Now, what are our investment thesis? So, nope. All right. So this is going to be primarily rising demand due to necessary demand due to the memory wall. The second is going to be their unique ability to provide the lowest and most efficient RAM in the and the supplier to AMD and NVIDIA. So what is the memory wall? So the memory wall, also known as the Von problem, describes how fast RAM performance increases compared to processing technology. It's important to note that memory basically is the thing that feeds directions to your processor. And so if your processor is chewing through directions faster than can actually be given them, that is a lot of downtime. And so basically what you need to do is you need to buy enough quantity of memory in order to match that processing line. And as you can see, these slopes are not even anywhere close. So that means as we get further and further into the generations, you need to buy increasingly more and more high bandwidth memory in order to match your processing speed. Now, this is in theory. Let's look at how it actually looks generation to generation. So this is how it looks actually generation to generation. You can see that top line is going to be your processing speed, and that green line is going to be your memory speed. So you can see not only is it just in theory, but this is real world things. That H100 at the very top right is going to be NVIDIA's 2 generations ago data centers that they were selling. Now, that's just a pitch for the high bandwidth memory sector in general. But what makes Micron special within the space? Well, that's going to be their power efficiency. Oops, sorry. So just to throw out some facts, power draw of data centers is expected to go from 3% up to 9% in the next 5 years of the world's total power consumption. Along with that, the United States is planning on spending $200 billion a year over the next 5 years, or up to $1 trillion on its electrical grid. As operating costs increase for these hyper data centers, you can see that making low power components is going to be increasingly more and more of a big deal. Actually, as I noted earlier, you have to keep shoving more and more of these into your data centers. Now, what makes Micron special is that, as NVIDIA reports, that better performance, and alongside that, 30% better power efficiency when compared to its competitors. Now, what does that look like in terms of shifting market shares? So up until 2023, NVIDIA only used one supplier for high bandwidth memory, and that's a company called SK Hynix. But after 2023, when Micron released its HBM3E memory, which is its leading powered, more efficient memory, they actually switched over to use them as well. Now, but what does this look like for the future, especially when contrasted to SK Hynix, which is the only other NVIDIA supplier? Well, Micron reports a 20% increase in power efficiency generation over generation. And now this might scare you considering that SK Hynix has a 4% generation over generation increase. However, it's key to note that Micron's doesn't actually include their next generation process that they use to manufacture it, which will add another 20% power efficiency on top of their generation over generation, meaning that compared to SK Hynix's 40% power efficiency generation over generation, Micron's will actually be 44%. On top of their already 30% lead. So it's plain to see that not only does this matter in terms of market share shifts, it also, Micron is only one gap. Now, competitors. So I mentioned a name back there a couple of times, SK Hynix, and it's one that I didn't know about until I started researching this stock either. Now, the competitive space is a bit interesting because there's only 2, and especially for something as high in demand as this high bandwidth memory is, it's very important to analyze each competitor and who they supply, considering that there's only 2 main suppliers. They're only supplying 2 main people, which is going to be AMD and NVIDIA. So for SK Hynix, SK Hynix is a Korean company that makes the same things Micron does: high bandwidth memory in general, and data storage solutions. They currently are qualified to supply NVIDIA's current generation, which will be Blackwell architecture, and their next generation, which is going to be their Rubin architecture, though it is key to note that they do not supply AMD. And we'll go over why that is important in a couple slides. Samsung, on the other hand, is a Korean company which makes a whole lot more of just data and memory. They own a baseball team and skyscrapers. They currently supply AMD's current generation, though they are not qualified to supply NVIDIA's current generation or NVIDIA's next generation. And what I would like to note is Samsung HBM4 memory, which is going to be the next generation, they have repeatedly delayed pricings for, and they are very behind on the manufacturing schedule. They have not released a date on when they are going to start ramp up production, and they have not released specifications, and they have still not qualified to even produce a memory titled as HBM4, which has to meet, I think, 1.2 terabytes of mega transfers per second, I believe. So why does AMD matter so much? AMD recently signed a 6 gigawatt deal with OpenAI in order to produce servers for them for their data centers. And now, as AMD says, that this will reflect on the income statement about $100 billion in revenue. Why is that important? High bandwidth memory accounts for about 15% of any server or data center. So that means that whoever can get this deal is going to reflect at $15 billion on their balance sheets as well. And since Micron's HBM memory segment in particular has margins from 45 to 60%, this could increase cash flows by up to $7.5 billion just alone. Alongside that, Team Red is better to be in because they historically more memory in general than NVIDIA has. But let's say you aren't Team Red. Well, keep in mind, Micron is the supplier for both NVIDIA and AMD, meaning that if either does well, it's still just for Micron. Now, Micron's positioning. So it's very important in this sphere to make sure that you aren't outdone technologically, and especially of when you release your information, when you release your next generation. So this was a problem in 2 times. This was a problem for SK Hynix in 2017, and this was a problem for Samsung in 2023, both of which Samsung in 2017 released their HBM2 memory by about a year ahead of SK Hynix's, and that'll reflect market share graph that I'm about to show you. And then you'll see the shift from that when SK Hynix released it about a year earlier compared to Samsung. Now, this is going to be the market share graph comparatively. See that huge fall from Samsung? This is because they failed to get qualified for any NVIDIA, and that all of that SK Hynix growth in market share was primarily NVIDIA position. Samsung still services is that AMD position. And so what I would like to say, more plausible than not, is that next year is projecting to actually have better servers than NVIDIA does. Well, they don't even qualify for NVIDIA's. What's to think that they'll be the supplier for AMD's who's trying to even be better than them? So what I'm trying to say here and tell the story of is that similarly to what happened between SK Hynix and Samsung back in 2023 is what's going to happen over the next couple of years between Micron and Samsung. So for financial analysis, so let's learn why we've been talking so much about memory and concluded. So I know that there's different words because they recently reclassified on their balance sheet. That far left is going to be your HBM memory. The second one is going to be your just average consumer, the memory that goes into your laptop. The third is going to be the memory that goes into your phones. The third is going to be the type of memory that goes into everything from industrials all the way to your cars. As you can see, margins are very, very, very high at 45% for the high bandwidth memory. And this is calculated before, so SK Hynix recently signed a deal with NVIDIA for the next generation to increase spot prices for HBM memory by 50%. So these margins are actually looking closer to 60% than 45%. And now what I would like to talk about is that net income. And so before 2023, Micron primarily sold that MCBU segment, which is going to be your mobile phones, but in 2023 they had to reposition due to a fallout with China. China completely stopped all sale of their products in the entire country. And since China is huge in the mobile phone space, their revenues were cut by about 70%. However, Micron has used this opportunity to since switch what they're investing in into the obviously higher margins. And that's reflected in how high of an increase we've seen year over year on that net income. But what are they doing with this net income? So Micron has recently purchased 3 fabs in Taiwan, which statistically has a higher growth rate. And they also do plenty of business there. And so not only are they investing in the right places, are they growth rate than America? And so not only are they investing it, they're also investing it in the right places where it's making them the most money. But if you are worried about import tariffs specifically, Micron also got $10 billion from the U.S. government to build 2 super fabs. One will be in Boise, Idaho, nearing completion in 2027, and the other one in New York in 2030. So both of those, so not only are they investing here, which will be beneficial in case tariffs do stick around, as Thaddeus noted, but they're also investing overseas, where most of the has been recently. Here's the DuPont analysis versus self. 22%, sorry, Micron has a 22% profit margin, 0.49% in total, 0.49 total asset turnover, 1.53 leverage ratio, 17% return on equity. And now let's compare it versus its peers. I understand it's not completely fair to value Samsung at considering they sell so much more diverse products. However, it is still, I feel, important to put them up there given how important they are to the thesis. Now, I've had a lot of, there's raised eyebrows at that SK Hynix, especially that return on equity. And it's important to remember that the thesis for Micron is not that they're doing better right now, it's that in the future, they have much higher growth opportunities due to their strategic partnerships with AMD that SK Hynix does not have. SK Hynix has basically put all of their eggs in the one NVIDIA basket. And so remaining much more diverse, that's what the thought process is versus Micron versus SK Hynix. So for risk assessment, we have obsolescence. Obsolescence is going to be what's happening with Samsung right now. So Samsung's failure to qualify and failure to produce any modern memory is why that market share is going to be taken from them. And so that's what it would be if a competitor of Micron were to release, let's say, HBM5 a whole year ahead. But considering that HBM4 isn't even out until next year and won't be implemented into any data centers until next year, and they've already qualified, at least for NVIDIA, it stands to reason that that is much, much a percentage. Now, bad yield. Since they are experimenting, especially with new processes for actually making these, what could happen is manufacturing costs could increase as you're just not refined at it. You just have bad yield in terms of how much are versus not successful due to the high complexity manufacturing process. However, this isn't as likely considering that, as I said, previous slide, Micron is leading off with their old process so that this doesn't happen and match supply and slowly blend newer process as they perfect it. Oversupply risk. So if demand were to sharply fall, you could be left, since supply chains are planned out years ahead, you could be left with cars sitting on the lot, so to speak, and excess inventory buildup would compound along with obsolescence as technology progresses and you have things that aren't selling. And now the final one is going to be rare earth material trade. Why is rare earth material trade important? Well, that's because China currently sells 70% of the world's rare earth materials. And this is a key input to any HBM manufacturing. And China recently threatened as of October, I believe, to stop selling any and all rare earth materials to the United States. But why was this? Well, it turns out not only does rare earth materials go into high bandwidth memory, they also go into F-22 fighter jets and F-35 fighter jets. And so for general security reasons, they were threatening that has since passed. But whatever came out of this, I would like everyone to know is that Brazil number at 0.53%. So Brazil, despite only supplying 0.53% of the world's total supply of rare earth materials, actually has the next highest after China. And so since the entire scare with China, things have recently gotten restarted up in Brazil. And Brazil's Rare Earth Material Council, who decides policies and incentivizes companies to actually mine there, has recently gotten back up again. And so not only was this a risk that has passed, but it could be a boon for Micron, as Brazil, if they do continue to ramp up, and China, if they don't stop selling, well, this could actually flood this. So this actually increase supply, lower cost, and increase the already absurd margins. Here's our discounted cash. So as you can see, this is really why it was so low and why we decided to go so conservative. This stock has increased 101% over the last 3 months. Started value. Since I first did my DCF, it has increased almost 30%. I did my last presentation, it's increased almost 20%. And so naturally, with it being so volatile, I had to go more conservative, especially since the fund, as Thaddeus and the risk management were saying, values lower beta. For the discounted cash flow, the way I calculated that was the percentage of that AMD deal that they captured. Multiplied that times the margin and figured out what that would look like for free cash flow growth rate. Here's the sensitivity analysis. Again, 50% of these are red, but as Dr. H has already stated, might not entirely be a stock that the fund would look at right now due to the increased volatility as of late, but I still believe in it as a long-term holding. And as it's increased, there's just sometimes there's nothing you can do about when I started doing this presentation, it increasing over 50%. And so I apologize for the sensitivity analysis being 50% red, but as I would like everyone to note, comparatively compared to a 273%, 273 target price, that going down to 213 if they were to have bad GDP growth compared to 377 if we were to, it's still weighted towards, it's still a good investment in my opinion, even with the risk, which is what I was trying to say with the entire valuation. For the relative valuation, historical PE times earnings per share. So their historical PE has been 11. That does include the TRO year in 2023 when they did get blocked from that, but their earnings per share is 17. Now, the way I calculated the bear, bull, and bear was that bear case was going to be that base of 11. And I used for the base and bull cases going to be what semiconductor manufacturing companies normally trade at when they're mid-cycle, which is going to be 15 and 6, sorry, it was 16 and 17 historical PE. That is for a blended valuation. I weighted both equally since I think that not one is going to be more right than the other, though I would put a little bit more stock in the relative valuation, as that's how most firms do actually value this company, as me and Hunter were talking about one day in the lab. That comes out to an average of $276, which represents a 5.8% upside. Thank you, everyone.
Hey, comment to all four of you, since you're the last presenter. You all speak well. You're obviously comfortable in front of an audience. I've said this for 10 years. Students speak too fast and they try to convey too much information. So you threw a ton of stuff at us. It's obviously, you've spent a great deal of time researching it. So I congratulate you on that. You said some key points that when you said it so fast,
Yeah.
I wanted to hit the pause button.
Yeah.
Because they were significant, because you made a comment about cash flow.
Mhm.
And I wasn't quite sure if I heard that right. But if we can go back to your first slide, I want to make a comment and suggest you think about something, since you like the company so much. All right, my reaction to the divergence in the growth rates, processors versus memory. Keep going.
Okay, yes, sir.
Okay, so basically what you're saying is, as these processors get more sophisticated, they're limited by the high bandwidth memory, right? So basically what you're arguing then is high bandwidth memory is a commodity, because in other words, you need more of their chips to support one processor.
Yeah.
Well, that means they're going to have to keep their unit costs low.
Sir.
Right. So when you're looking at on a semiconductor basis, it is vital to understand what the unit costs are going to be, because that's going to drive the scalability of their business, all of the factors that went in. So now that's why when you put up this chart, I wanted to understand, and you hit the key word. You said something about cash flow. Can you repeat what you said about cash flow?
I don't, which part of the presentation was that?
I don't even remember. You said it so fast, but you said you made a comment about cash flow.
Well, if you were worried about costs in order to make them, since you're right, it is a quantity type thing.
Yes.
Quality, because the quality doesn't increase as fast.
Correct.
Margins have been historically for this sector, margins have historically for this sector only gone up as of late. And that's a key thing to note, is especially for the next generation of HP memory, the prices for these are actually going up by 50%, despite not having a ton of extra. For this in particular, there's not a ton of costs that change. Only the manufacturing costs would change. But due to the fact that NVIDIA is willing to pay for up to 50% more, and that they're already sold out until 2027 for all high bandwidth memory, I don't think that that's a risk yet, though that would definitely be a risk if the rare earth material trade were to hit them and hurt their manufacturing.
So the next 2 to 3 years has a great deal of visibility. I understand, but you know, a big chunk of the valuation is going to be.
Yeah.
I'm going to ask that you revisit that.
Oh, how did I do that? Oh, sorry.
Okay. So then if you can go back to one more question to the segments,
Okay. Yes, sir.
that.
Here.
Is this on? Okay. So on a revenue basis, you're looking at two segments. And again, I don't know what margin that is. So you should identify if that's operating or gross. Do you know?
That's gross margin, sir.
Okay. So on a gross margin basis, which argues then therefore, you know, you have a net profit margin of about 27%. So I'm looking at this looking at roughly $17 billion with gross margins below 20. And then you've got another 20 billion with gross margins roughly high 30s.
Mhm.
Right.
Sir.
So the blended gross margin is going to be in the 20s,
Mhm.
somewhere in it. Why do you consider that a high margin company?
Because that revenue, especially for that $13 billion number 1 year ago, as of August, that was I think 3 billion. And so it's over quadrupled since that year. And so the reason why it's important especially is because it is it's their fastest growing by far. And so as that continues to grow, it'll be a higher and higher percentage and make up.
Right, but it's
question.
highly improbable that the margins will stay at 45%.
It's high. I think I see where you're coming from, but could
Right.
you explain a little bit more?
Well, if I'm modeling this, there's no way I'm going to maintain 45% margin, especially since they've got a gift because Samsung screwed up. So to the extent that Samsung comes back in a competitive manner, you're going to see price cuts. But more importantly, you're dealing with at most 2 or 3 key buyers of their product.
Sir.
They're going to know the unit costs and they're going to negotiate
Absolutely.
that down because they have to buy more volume.
But you're right that
So the margins are going to come down, is my point.
they would negotiate the unit cost because they're ordering so much quantity.
Correct.
But
That's happens all the time.
okay. Yes, absolutely. I'm sorry. I'm just going to ask this, but I just don't understand like the macroeconomic, and obviously you've been doing this a lot more, so I'm going to pick your brain. But why wouldn't it increase like, because as stated, since they need it so much, but so much more, and as spot prices increase 50% generation over generation, and generation over generation, it compounds on how much more they need. And since they do truly need it in order to actually make their process work out efficient, wouldn't that drive up, not down? Because they would lose control because they need more and more. There's actually less supply, generation over generation.
If NVIDIA wants to buy 200 of something in 1 year, and they go back to that supplier the next year and buy 400 of it,
okay,
they're not going to pay the same unit basis. They're not going to pay double.
I get it now.
Okay.
Thank you, sir. I appreciate it. Thank you.
Do we have any more questions? Okay, we can also always give some feedback to him afterwards. I know some of you often do that. We went way overboard. We will not do that next time. I do want to point out that we still have a free meal waiting for you at UJ's. So those of you that have questions, we'll get to it later. Thank you all very much for coming to this ISM.
Sir, I appreciate it.
Yo, yo, yo.